We have to talk about the economy today, but not jobs. We're not going to talk about labor or unemployment. We're not going to talk about wages. The discussion today is the growth of the American economy. We now have economic growth numbers for the second quarter of 2015. And the long and short of it is that the economy grew more than expected, measured by the GDP. The GDP, the gross domestic product, is the monetary value of all goods and services produced within the nation's borders during a specified period of time. And during the second quarter of 2015, the growth rate was 3.7%, up from the 2.3% that the Commerce Department had reported last month. Why did we see 3.7% GDP growth during the second quarter? A couple of reasons. Number one, increases in consumer spending. Number two, increases in business spending. What caused the increased spending? Continued employment gains. So even though this conversation is not about employment, employment gains contributed to the increase in spending. If more people have jobs, more people have more money to spend. Rising home prices, as well as cheaper fuel costs. If you spend a little bit less on fuel, Lewis, you have a little more money left over to spend on other things. So far, pretty straightforward.
I think I'm following you here. Yes.
Possible problems looking forward with regard to GDP. Well, we saw rising inventories and stockpile levels for businesses during the second quarter. The reason this can suggest a possible downward correction in GDP growth in the future, a good analogy is if you go out in September and buy all of the groceries you need for September, October, and November, you would expect that in October and November, you would see reduced spending on groceries. And it's the sort of same logic that we're applying to increased business inventories. If businesses are producing more inventory ahead of time, purchasing more inventory ahead of time, it would stand to reason, sort of adjusting for demand, that at some point in the future, you would see decreased inventory production or purchase, but we will continue to see that. The big issue now becomes whether the Federal Reserve should raise interest rates. The benchmark interest rate has not increased since 2006. And you might be saying, well, why does this matter? This is really important. The sort of equilibrium state for this federal funds rate, which is the rate at which banks can borrow money from each other, it's sometimes called the overnight rate, that rate is artificially low. Historically, it is not this low. And the idea of keeping it low is to encourage people to, for example, buy homes or spend money on credit, because mortgage and credit card rates are sort of tied to this overnight rate, the federal funds rate. But as I mentioned, it is not a sort of equilibrium long-term state. So the concern is you keep the rate artificially low, you're going to see a housing bubble develop. You're going to see too much consumer debt taken on credit cards because the interest rates are lower. So long-term, the consensus is a strong economy should coincide with some increase to the federal funds rate. It remains to be seen whether that will happen. The Fed has hinted at an increased federal funds rate, but we saw that recent market downturn last week, and some are saying in the financial world that the Fed will sort of reconsider how soon to raise rates. That is going to be an indicator going forward, Lewis. And of course, we'll keep watching, because 3.7% GDP growth is far better than the 1.8 to 2% that the Obama haters say is just not going to be enough for the American economy.
Of course, the GDP growth is great, but at the same time, let's not pretend that that's the only thing we should be focusing on. I mean, we have serious problems here. Still, of course, it's a good thing.
No question about it. And really, this is just one element of the financial picture that we talk about all the time. It doesn't by itself tell us anything definitive about the future of the American economy, but it is an important component.